Before we begin on our topic for today's presentation, which is establishing presence in India for foreign entities, given the growth map that the Indian economy is currently following and has placed itself from the 10th spot as world's largest economy back in 2019 to the 5th spot in a span of 2 years, the Indian market and the Indian consumer is largely the most important and pivotal aspect that foreign entities in today's day and age need to consider. And if they forego entering into the Indian market, then they are definitely missing out on something. With that introduction, we shall proceed with the various ways in which a foreign entity can consider setting up presence in India. So before we begin with the some substance of our presentation, I'll briefly tell you about the contents or the points that we'll be discussing during the course of this presentation. Right, we'll discuss the key modes of setting up presence in India, which could be either through a liaison office, a branch office or a project office, an unincorporated joint venture, or a separate entity in the form of a subsidiary. We'll discuss about key risks associated with each of these modes, such as the risk of creating a permanent establishment in India, or the risk of a foreign entity having a residence in India by way of having its place of effective management in India, or an AOP risk, which is abbreviated here, but is termed as an association of persons. When we discuss these risks, we'll also discuss about the key risk mitigation strategies, the key do's and don'ts while setting a presence in India to avoid such risks. We'll discuss about the jurisdictional analysis for a tax-efficient cash repatriation system, which is important to consider for foreign companies while they set up base in India. And we'll also discuss anti-abuse provisions in the form of transfer pricing norms, thin capitalization norms, and the general anti-avoidance rules in India. Now, before we discuss how a foreign entity can set up its presence in India, it is relevant to understand how foreign companies are taxed. So foreign enterprises are largely taxed on their business income in India at the rate of 40% plus surcharge and cess on net basis, that is net of the expenses. However, such business income is only taxable in India if the foreign company has a fixed place of business or a minimum threshold for a business presence in India, which in tax treaty terms is known as a permanent establishment. Right? In case where no tax treaty exists, such threshold could be much lower because of the concepts such as business connection, which are similar to a P, but much wider in context under the Indian Income Tax Act, and the concept of significant economic presence, which is often termed as digital tax under the Indian law. We'll discuss this in further detail when we discuss about the PE risk. Another important aspect is to identify which income streams for foreign entities are subject to withholding taxes, because Indian tax authorities are fairly aggressive when it comes to source-based taxation. And therefore, any income stream, whether it's in the form of interest, royalty, dividend, fee for technical or included services, or capital gains, needs to be vetted for appropriate tax withholding at the time such income streams become due to the foreign entity. Now we discuss the key modes of establishing presence in India. Now, when a foreign company is sort of evaluating how to enter the Indian market, there could be various modes for it to consider. These modes could include a very basic representative office presence in the form of a liaison office, It could include a project office or a branch office, which in itself creates a taxable presence for the foreign company in India. It could consider having an unincorporated joint venture with an Indian company, which is generally the preferred mode when foreign companies are bidding for projects in India. Or it could consider setting up a wholly owned subsidiary or a subsidiary in general terms in India. Now we'll discuss each of these modes. First off is a liaison office. Now, as we discussed, a liaison office is akin to a representative office of the foreign company. It is merely an extension of the foreign company, so it is not a separate legal entity, right? It's just an extension of the foreign company in India. And given that liaison offices are easy to set up, have low minimal capital requirements, and only have to show a profit-making record for immediately preceding 3 years, these may be the easier, one of the easier modes for a foreign company to test waters and sort of, before establishing business operations or full-fledged business operations in India. Now, even for a liaison office, it is set up under the express approval of the RBI. And there are a permitted set of activities that liaison office can carry out. So very broadly, a liaison office cannot carry out any business activities at all. The whole sum and substance of opening a liaison office or a representative office in India for a foreign company is to be able to carry out research activities, collection and collation of data from the Indian market, acting as a communication channel between, say, Indian clients and the foreign company, right? And any revenue generating and or business activity of the foreign enterprise is not allowed to be carried out by the liaison office. So by the sum and substance of these activities, we can see that the permitted activities for a liaison office are typically preparatory and auxiliary in nature in the context of whatever business the foreign enterprise is carrying out. Given that these activities which are permitted by the RBI are only preparatory and auxiliary in nature, by itself, a liaison office will not create a taxable presence in India, and therefore, the permanent establishment risk, which we are going to discuss later on in this webinar, is not really a concern for in case of liaison offices, as long as the scope of its activities is limited to or restricted to the scope of permitted preparatory and auxiliary activities. However, if the liaison office sort of steps over such preparatory and auxiliary activities and starts conducting certain activities which may be revenue generating in the context of the foreign enterprise's business, then it may be relevant to evaluate the permanent establishment risk for the foreign company on account of such liaison office and such activities in India. The next mode could be a branch office or a project office. Now, a branch office per se is a taxable presence of the foreign company in India. Like the liaison office, this is also an extension of the foreign company. It's not a separate entity. And it gives rise to a full-fledged permanent establishment of the foreign company. Project offices are typically created by foreign entities, or I should say they are allowed to be created by the RBI when there is an approved project and there's a list of permitted activities that the RBI prescribes for project offices to be opened. So where a foreign company has won a project that it requires to undertake in India, a project office can be opened by the foreign company in India. Now, depending, because branch offices and project offices are not separate entities, they are largely dependent on their head office. Like the liaison office, the liaison office is not permitted to carry out any business activities. So it's entirely dependent on its head office for all its expenditure in India. In case of branch and project offices, because they are allowed to carry out business activities and they create a taxable business presence in India, they are dependent on the domestic activities as well as the head office for all their funding needs. Given that this mode of presence through a branch or a project office creates a taxable presence and creates a permanent establishment, or what we call a PE in India, for the purpose of attribution of profits to such PE, transfer pricing regulations may also apply between the head office and the branch office or the project office. Now, what this means is, first, let me explain the concept of PE and then the attribution bit and why transfer pricing applies. Now, a PE by itself is the minimum threshold for creating a taxable presence in India. Once a taxable presence or a PE is created in India, the profits of the foreign enterprise, which are attributable to such Indian PE, become taxable in India. Right? Now, for the purpose of attribution of these profits to the Indian PE, the Indian tax rules and even the OECD guidelines, they treat the head office and the branch office or the project office as two separate entities. And transfer pricing regulations help in sort of ascertaining whether transactions between the PE and the head office are at arm's length, or any additional profits need to be attributed to the Indian PE, which will be subject to taxation in India. Now we'll discuss more in detail about the PE risk that we have been discussing in the context of creating a direct presence in India by way of a liaison office or a branch office or a project office. So like we discussed, a PE is basically a minimum threshold of physical presence that a foreign enterprise must meet in the source country to be subject to taxes there in respect of its business income. So there may be, for a foreign enterprise, there may be two sources of income. One could be a direct source through business income that it earns in the source country, say India, and other could be passive income streams such as interest, dividend, FTS, royalty, etc., which may be subject to source-based transactions. Now, the PE concept is mainly relevant in the context of business income, because if there is no PE of the foreign enterprise in India, then the business income of the foreign enterprise is not subject to tax in India. It is only when a minimum taxable presence by way of a PE is created that the business profits of the foreign enterprise get subject to Indian taxes. Now, a PE may be created in one of the following manners. If the foreign enterprise has a fixed place of business, like we discussed, it could be in the form of a branch or a project office, a warehouse, a place of management, a workshop, a hotel room, which is used as an office by its employees in India. And such fixed place of business is used for the business activities of the foreign enterprise. And such business activity is carried out with some degree of permanence. And the foreign entity has a degree of has disposal over such premises. That is, it has some degree of control over some at such premises. Then a fixed place permanent establishment or a fixed place PE may be created. A service PE may be created where the foreign enterprise sends employees in India to service its clients in India or to service its affiliates in India. Another form of PE, which is called an agency PE, may be created if a dependent agent in India is negotiating and concluding contracts for and on behalf of the foreign enterprise, or is securing orders for and on behalf of the foreign enterprise in India. So an agency PE will not be created if the agent is an independent agent. So if, say, there is an independent consultancy agency which is acting in its ordinary course of business, and among its many clients is a foreign company X that we are talking about, then such independent agent, because this agent is not economically and legally dependent on company X, will not create a agency P. But this becomes more relevant in the context where, say, the foreign enterprise hires an independent contractor in India. The terms of contract between the foreign enterprise and the independent contractor are at arm's length, but there may be considerations where such foreign contractor is either given, say, the designation which may allude to an employer-employee relationship, such as, say, AVP or head of tax of India or head of operations in India, etc., which may be visible on the website or other legal professional networking sites, that may give rise to scrutiny. And as such, these considerations are very important while vetting for PE exposure, whether it's for fixed place PE, a service PE, or a agency PE. Now, once a foreign enterprise sets up a PE in India, it will need to maintain separate books of accounts in India for such PE for the purpose of tax payment and audit. Because like we discussed, for the purpose of attribution of profits to the Indian PE and the head office or the foreign entity are then treated as separate entities. So the Indian PE will need to maintain separate books of accounts to show the assets employed and the income that it is generating in India. Now, in case a PE is created, the profits of the foreign enterprise that are attributable to the Indian PE become subject to Indian taxes at the tax rates that are applicable to the foreign company, which is 43.68%, as we mentioned here, inclusive of surcharge and cess. Now, while we've discussed some of these factors, we'll discuss them in a little more detail here, factors that can give rise to a PE. Now, for a fixed place PE having any place of business through which the activities of the foreign enterprise, business activities of the foreign enterprise are carried out with some degree of permanence, and such place is at the disposal of the foreign enterprise, may create a fixed place PE. This could this could arise where, say, the foreign enterprise sends some employees to India, to the premises of its vendors in India or its subsidiary or affiliate in India. And these employees have dedicated computers or workstations in India from which they are carrying out their activities. It could also be where employees of the foreign enterprise visiting India are carrying out business activities from a hotel room. So, and the criteria basis which a fixed place PE would come into picture will be very fact specific and will depend on the nature of business. Like in one of the cases, the courts have held in Formula One that even the activities that were conducted for a race car event, even for a single day, gave rise to a PE in India. So these are factors that need to be very well discussed within organizations and then implemented to mitigate PE exposure. Another important aspect, like we were just discussing for agency PE, is where an agent is hired by a foreign company in India, and such agent is dependent on the foreign company for its legal and economic benefits. And such dependent agent then habitually is either securing orders on behalf of the foreign enterprise in India or negotiating contracts. then such dependent agent will be treated as an agency fee of the foreign enterprise in India, and any profits that are being that are attributable because of such dependent agent will then be taxable in India. Now, when a subsidiary or a separate company is per se created, or if there's a separate company that is carrying out back office operations for a foreign enterprise, that per se will not really give rise to a PE in India, unless there are employees from the foreign company visiting India, or other factors for a fixed place PE or a service PE or agency PE, like we discussed earlier, are present in such a case. Of course, there are certain exceptions to the concept of a PE. So say if employees of the foreign entity are visiting India for in order to maintain control and quality of the work that the Indian entity is doing for the foreign entity, then such activities may be qualified within the realm of a shareholder activity or a stewardship activity, which is specifically relevant in the context of back office operations being set up in India, where the foreign entity is sending employees in India to check that the quality of the work being done by the Indian back office is up to the mark and it meets the quality standards of the foreign enterprise for the work to be or for the work product to be given to its customers globally. Where employees are supposed to be sent to India for prolonged durations, there may be other considerations that may be considered by a foreign enterprise, which could be such as exploring appropriate secondment arrangements for such employees. However, it is important to note that even in such secondment arrangements, there should be some degree or some level of integration of the employee with the Indian enterprise. And this we'll discuss further in the next slides. Now here we've captured, basis the broad discussion we've had so far, we've captured some of the do's and don'ts which are relevant for managing this PE exposure. So some of the do's are that if there's an independent contractor, such contractor should be remunerated at arm's length to prevent any additional attribution to the Indian PE. In such case, the foreign enterprise may conduct a transfer pricing study and keep such transfer pricing study handy to be considered by the tax office in case there is a scrutiny. Second is that there should be a clear demarcation of roles and responsibilities of the risks and rewards with the contractor in India. Another important aspect is that where employees of the foreign enterprise are visiting India, which may give rise to a fixed place PE or a service PE, the foreign enterprise needs to closely monitor the duration or the time thresholds for which such employees are visiting India. So most Indian tax treaties would prescribe for a minimum time threshold of say 90 days in a 12-year period, or 3 months in a 12-year period, or 6 months in a 12-year period for a service PE to be created. A fixed PE, normally no thresholds are prescribed for a fixed place PE, and such consideration will have to be seen in the context of the business of the foreign enterprise, whether the stay of the foreign company's employees would constitute a fixed place PE in India. However, where such stay is for prolonged durations, like we discussed, foreign entities may consider exploring suitable secondment structures. Now, what a secondment structure really prescribes is that the employee from the foreign company is hired by the Indian company and or the Indian entity where the employee of the foreign company is supposed to work or supposed to be stationed. And such Indian entity then, for all legal and economic purposes, becomes the employer of such an employee for the period of the secondment. So in such cases, while there may be for continuity of employment purposes, there may be certain social security benefits that the employee requires, or the foreign company is required to continue in the foreign jurisdiction. However, the cost of the employee and the services of the employee would be then cross-charged to the Indian entity, such that the economic burden of the employee in India is borne by the Indian entity and not the foreign entity. Another important consideration while discussing secondment structures or exploring suitable secondment structures is having some level of integration of such an employee in the business of the Indian entity, right? So that it does not appear that in sum and substance, such an employee is basically an employee of the foreign entity. Such employee, for example, should not have any tools of the foreign tools or resources given by the foreign enterprise, should not be subject to direct control and supervision of the foreign enterprise, and therefore should be subject to direct control, supervision, disciplinary activities, employee policies of the Indian entity and not the foreign entity. Right. Similarly, like we discussed, any disciplinary action or the lane on the employment of such an employee should not lie with the foreign entity, but should lie with the Indian entity. So while some of these factors may not be practicable in all scenarios, but on a fact-to-fact basis, an appropriate secondment structure could be explored by a foreign entity where it has to send certain employees in India, and the scope of work of such employees is not covered or exceeds the scope of stakeholder activity or shareholder activity or stewardship activity that we discussed earlier. Another important point is that the control of the contractor should be restricted to stewardship activities. This we've just discussed. Now, what are some of the don'ts that are important for managing the PE exposure of the foreign company in India? Some of these points are that any contracts, correspondence, and actual conduct should indicate should not indicate in case of a contractor that the authority lies with the contractor or the Indian enterprise or any dependent agent in India to negotiate or conclude contracts. So the Indian contractor should neither have the legal right or authority to negotiate, conclude, or secure contracts for the foreign enterprise, or secure orders for the foreign enterprise, and should also not do these activities in sum and substance. Like we just discussed, another important or relevant point is that social media references in official and networking websites and business cards should not allude to a PE exposure. So say if an independent contractor is hired by a multinational enterprise and such contractor is present in India for evaluating the Indian market conditions prior to setup of a full-fledged business presence, if the designation of such a person alludes to a dependent agency PE relationship, such as having designations of such as which are similar to that of an employee on, say, LinkedIn or business cards or such other websites or website of the company, then that may allude to extra scrutiny. And Indian tax authorities are very aggressive while scrutinizing cases dealing with PE exposure. One of the last points of the don'ts that we've covered in this presentation is that the visiting employees of a foreign enterprise should not have any fixed place or room. So basically, they should not have a fixed place which is at their disposal at the premises of the Indian entity, so as to avoid giving rise to a fixed place PE. Now, moving on to the next mode of creating a business presence we will discuss an unincorporated joint venture. Now, what an unincorporated joint venture means is that the foreign entity, in this example, FCO, and the Indian entity, in this example, ICO, will not come together and incorporate a separate entity, right? There may be circumstances where commercially it works best for the foreign party and Indian party to not form a subsidiary and be subject to multiple compliances in India, but just collaborate on a project working towards commonness of purpose to earn income by execution of such project in India. Now, why this is relevant and why this is a risk is because when two or more persons are working to undertake a joint enterprise with commonness of purpose, with commonness of risks and rewards, they may be treated as an association of persons or an AOP under the Income Tax Act. Now, an AOP is a separate taxable entity which is recognized as such under the Income Tax Act. Why that is relevant is because if the AOP becomes an Indian resident, then the foreign company will not have the benefit of seeking tax treaty, will not have the opportunity to seek tax treaty benefits or credit for the taxes that it is required to pay in India. Right now, why is AOP risk important for to be considered and mitigated for unincorporated JVs? Like we discussed, an AOP can be considered to be a tax resident in India in any previous year in all cases where control and management office affairs are not situated wholly outside India. So to clarify, where the control and management of the affairs of this joint enterprise entered into by the foreign company and the Indian company are not wholly situated outside India. That is, even if there is some degree of control and management for carrying out the project, which is the joint enterprise that the foreign company and the Indian company are carrying out. If such common control and management is present even to a certain degree in India, the AOP may be classified as an Indian tax resident. And as a result, if the AOP is treated as an Indian tax resident, the entire income of this joint enterprise, which is the AOP, net of any tax deductible business expenditure, of course, would be taxed in India in the hands of this AOP. And like we discussed, since the AOP is then treated as an Indian tax resident, it does not have benefit of taking credit of the taxes it pays in India. So the foreign company will be deprived of taking credit of the taxes it pays in India in its home jurisdiction. So in such cases where the AOP is determinable, right, where shares of the foreign company and the Indian company forming the unincorporated joint venture are determinable and clearly ascertainable, in such cases, the taxation would be that each member would be taxed at its applicable rate. So a foreign company would be taxed at the rate applicable to a foreign company, which is 43.68%, and the Indian company would be taxed at the maximum marginal rate, which comes to about 42.74%, assuming the maximum surcharge applicable and the maximum cess applicable. Now, since we discussed that an unincorporated joint venture can create an AOP, it is relevant to discuss in further detail what are the attributes of an AOP and what are the circumstances in which an AOP will not come into existence. So very broadly, and we just touched based on this in the earlier slide as well, very broadly, the attributes of an AOP would be the coming together or voluntary association of two or more persons Such association, of course, is voluntary and is towards a common purpose. That common purpose will be to jointly earn income in India. And there is a certain degree of common management or joint participation. Now, what this means is that if there are, say, only certain degree of control retained by, or if there's certain degree of joint management on account of, administrative, retained only on account of administrative purposes or administrative management of this joint enterprise, that may not be relevant. But if there is joint participation of both the entities in taking the key decisions for execution of the project or the business in India, for earning business income in India, that will be relevant for creation of an AOP. Now, given that when these provisions were introduced, there was not much clarity. The CBDT had also, in the context of EPC contracts, issued a circular describing the range of activities or the range of circumstances under which an AOP will not come into existence. However, these are general guidance principles which are also applicable to all cases and may be applied as per the facts of each case. And these are basically in juxtaposition to the attributes of the ingredients that are necessary for creating an AOP in India. These being that there should be an independence and separation in the roles and responsibility, the use of the resources, tools, costs incurred by each party or each member of the AOP, and the reward that it earns. Each member should earn profits or incur losses based on the performance of the contract, strictly within the clear and defined scope of the contract. So the contract should specifically identify the scope of the foreign scope of the work and the income to be earned, or the profit sharing ratio or proportion of the foreign company and the profit sharing ratio of the Indian company, the scope of work that the Indian company is required to carry out, the resources that the foreign company and the Indian company will rope in to carry out the work. And there should be a clear demarcation in these aspects. The last and the most important point, of course, is that there should be no joint control and management, except, like we discussed, for coordination and administrative purposes. Now, the last and the most preferred or common mode on a conservative basis for foreign enterprises for selection of creating a presence in India is by way of another separate legal entity form, which is by creating a subsidiary or any other separate legal entity in the form of a company, LLP, a wholly owned subsidiary, or just normal subsidiary. Now, given that a subsidiary is a separate legal entity, it is taxed at the applicable corporate tax rate, whether it's an LLP or a company, right? If it's a company, it will be taxed at the domestic company tax rates, which for service companies is broadly 25.17%. Given that it's a separate legal entity, forming a subsidiary, one of the major benefits it gives is ring fencing the PE risk of the foreign entity. So there is no default presumption as against in the cases of a branch office or a project office of creation of a PE in such a scenario. So unless any factor giving rise to a fixed place business or a service PE or a agency PE are actually present in the context of the tax treaty, there is no presumption that creating a wholly owned subsidiary, for that matter of fact, will create a PE of the foreign entity in India. Another important facet is that, of course, since it's a separate legal entity, the subsidiary can carry out its own business operations, generate business income, and even repatriate profits to the foreign parent in the form of dividend, interest, royalty, FTS, etc. Given that these will be related enterprises, they will come under the scope of associated enterprises under transfer pricing regulations, and all transactions between the foreign parent and the Indian subsidiary need to be at arm's length and meet such considerations as are required under Indian transfer pricing regulations. Again, if the foreign company is very thinly capitalizing such a subsidiary, then thin capitalization norms may also become applicable. And if the interest expenditure of the Indian subsidiary exceeds 30% of its EBITDA, then the excess expenditure may be disallowed in the hands of the Indian company. Now, one of the other risks that are relevant and should be considered by a foreign entity while setting up presence in India is the risk of becoming a tax resident by virtue of having its place of effective management in India. Now, where a foreign company has its place of effective management as defined under Indian tax provisions in India, then it is treated as an Indian tax resident for all purposes and is taxed as a domestic company. As a result of which, what happens is that the global income of the foreign company then becomes subject to tax in India, and any benefits under the tax treaty are then denied. Because it becomes an Indian resident, it cannot claim benefits that a foreign company can claim under the tax treaty. The most important being that in normal circumstances, a foreign company could then, even if it has to pay taxes in India, could claim credit of those taxes in its home jurisdiction. So such benefits will be denied if the residence of a foreign company is considered to be in India. Now, what is POEM? So POEM is defined under the income tax laws to mean a place where the key management and commercial decisions, so not just routine decisions for day-to-day operations, but key decisions which are necessary for the conduct of the business of the foreign entity as a whole are in substance made. So any key management commercial decisions which may pertain to the business of the entity, which are relevant to decide the direction in which the business of the entity of the foreign company will pursue as a whole, are relevant for considering where the POEM of the foreign entity lies. Now, this POEM test has to be applied for a foreign company on a year-to-year basis to determine the residential status of the foreign company for each financial year. And the threshold for applying this POEM test is INR 50 crores or 500 million. So if another important consideration is that now to identify or to ascertain where in which cases the POEM should be construed to be in India and in which cases it should be construed to not be in India, where a foreign company is having active business outside India, there is a presumption under Indian law that the POEM of such a foreign company will be presumed to be outside India because it has active business outside India if the majority of the board meetings of such a foreign company are taking place outside India. Now, there's an exception to this rule or this exception itself, which is the stand-aside rule. So even if a foreign company has active business outside India, but it is seen that the board is standing aside or not taking key decisions, and in fact, the key decisions which are important with respect to the management and control and commercial decisions necessary for conduct of the business of the foreign enterprise are in fact being taken by the Indian affiliate or the board of the Indian affiliate or its key managerial persons, then the POEM will be considered to be in India. Now, given that we discussed in the previous slide the exception for carving out a presumption against the POEM risk for foreign entities where the foreign entity has active business activities outside India, it is relevant to also understand what this ABOI criteria is. So the Indian tax law basically prescribes the criteria on the basis of which active business presence or active business outside India may be considered. And this criteria is that where, say, the foreign entity has passive income in the form of interest, dividend, royalty, or fee for technical services, or any intra-group sales. And such passive income is less than 50% of its total income. Sorry, there were some technical issues. Is the slide deck visible and am I audible? Sumita or somebody from the Taxmann team, can you please confirm?
Yes, you are audible, sir.
Okay, great. So we were discussing the criteria for determining when a foreign company is said to have active business outside India. Right. So this criteria is when the foreign company has passive income streams, such as interest, dividend, royalty, fee for technical services, or intra-group sales. And such passive income is less than 50% of its total income, where the total assets of the foreign company in India are less than 50% of its total assets worldwide. When the employee situated in India or employees that are tax resident in India are less than 50% of the total employees of the foreign company, and the payroll expense or the cost of such employees borne by the foreign entity, including any social security benefits, etc., that it's required to pay, is less than 50% of the total global payroll expenses. If these four criteria are met, the foreign company may be held to have an active business outside India. And in such cases, the presumption of having POEM outside India may be met if the majority of board meetings are being held outside India. Now, another very relevant consideration while setting up presence in India is also determining the cash repatriation strategy for the foreign enterprise and exit strategy at the point of setting up presence in India. So as you will notice from this comparative table of jurisdictions, there might be certain cases where a foreign company may be able to set up presence in India through one of these tax jurisdictions or any other favorable tax treaty jurisdiction, if say this consideration will be dependent on the right mix of cash repatriation strategy that the foreign company is going to employ. So say, for example, if it is only dividends that are being considered, then as against domestic law, it may be beneficial for the foreign company to consider favorable jurisdictions, say, such as Mauritius, wherein if more than 10% of the company is directly held by a Mauritian company, a beneficial rate of 5% may be available on dividend repatriations. Right? In case the Indian entity which is to be formed is going to be thinly capitalized, of course, in conjunction with the thin capitalization norms, then even having a direct subsidiary in India may work, because the domestic tax rates maybe are largely for such interest on tax withholding on interest income streams are largely at par, and in some cases even more beneficial than the tax treaty. So it is similarly capital gains on exit from the Indian entity may be a relevant consideration for the foreign entity while considering how to set up its presence. Now, even while considering how to set up this presence in India, it is very important while selecting a favorable treaty jurisdiction to be mindful of anti-avoidance rules and limitations of benefits clauses, and in general, meeting the commercial and substance requirements while creating a holding company structure for investing in India. So having discussed all these modes, we will quickly, I think we are short of time, so I'll skip the comparison. We've discussed each mode at length, and we'll quickly move on to some of the more relevant considerations. Right, we'll sift through these slides and see. So a liaison office, branch office, or project office is a way of creating a direct presence in India where no separate legal entity is formed. A direct presence in India is created. There are no branch profits tax in India. However, this may create a risk of creating a P, except in the case of an LO, where if the activities are restricted to preparatory auxiliary exception, then a P may not be created. In case of separate taxable entities, either in the form of subsidiary or where an AOP is created on account of an unincorporated joint venture, there might be relevant considerations. We mentioned the tax rates here, the withholding applicable on dividend distribution. Relevant to note that in case of an AOP, there's no dividend distribution tax on the distribution of profits. Right. So like we've seen from our discussion so far that there's no straight jacket formula for deciding on the correct mode of creating presence in India for foreign entities. So say for a foreign entity that is just looking to test waters in India and is looking to primarily do research activities, collect information about the Indian market, explore business activities without actually conducting such business activities, even creating a liaison office may be of relevance. However, if the foreign entity perceives that the scope of its activities is going to exceed preparatory and auxiliary activities, and it is in fact going to conduct a certain degree of business activities in India, then it may be relevant to consider forming a separate entity in the form of a wholly owned subsidiary or a subsidiary or an LLP in India. Now, like we discussed, there are certain anti-avoidance rules, two of them being specific rules and the general anti-avoidance rules, or GAAR, which is so infamously used in tax parlances today. So transfer pricing norms, we've already discussed. These are essential where there are transactions between associated enterprises. And the test is that these transactions should be at arm's length, should be at considerations that are present between unrelated parties. Such international transactions are required to be reported, and relevant documentation in terms of creating a transfer pricing study through a transfer pricing auditor, etc., are required to be created and maintained. Then there are thin capitalization norms that we discussed. So we discussed that if there's an interest expenditure in excess of 30% of the EBITDA of the Indian entity to a foreign affiliate or the foreign parent, then the excess expenditure may be disallowed, and such excess expenditure may be allowed to be carried forward for a maximum period of 8 years. Then there are general anti-avoidance rules, which are very wide in their scope and substance, and they basically codify the substance over form doctrine under Indian domestic tax law. The reason why GAAR is so infamously used, like I mentioned, in tax parlance, is because it gives very broad powers to Indian tax authorities to recharacterize transactions which may be perceived to lack commercial substance. But even though these rules were introduced back in 2017, GAAR norms have not really been tested, and we've not seen any judicial test of general anti-avoidance rules in India so far. So next in the presentation, we've just discussed transfer pricing, another important criteria as a specific anti-avoidance rule under transfer pricing is that transfer pricing may apply even for domestic entities, where one of these domestic entities is seeking a tax holiday. And the related party transactions of such an entity are in excess of 20 crores in a financial year. One last important aspect that I'd like to discuss before summing up the presentation is a deemed transfer pricing transaction, which is very relevant and often forgotten by foreign enterprises while entering into transactions that may have Indian legs. So where, say, two foreign enterprises are entering into a transaction in India for, say, sale or purchase of goods or assets, or there might be a small slump sale contemplated of the Indian business of the sell side as part of a multi-jurisdictional deal, and there's a prior arrangement between the non-resident parties in terms of the for the arrangement or this transaction that is to be undertaken in India. For example, say there has to be a slump sale of the Indian business by company A to company B. And company A has a parent company X abroad, company B has a parent company Y abroad, and X and Y decide that as part of our global transaction, we are going to sell the business of company A to company B. Then such a transaction may be deemed to be an international transaction because it is pursuant to a prior arrangement between non-resident affiliates of the Indian parties entering into a transaction. As such, these transactions are also required to meet the arm's length test under Indian transfer pricing regulations. So GAAR we've generally discussed. These are very broad-based rules. And I'll quickly run past it, given that we are passing the time limit for today's webinar. So GAAR rules basically apply to impermissible avoidance agreements, where the main purpose of such a transaction is to gain a tax benefit. Or it could be creation of rights and obligations which are not ordinarily created on arm's length transactions. It could also be where such a transaction results directly or indirectly in abuse of provisions of the Income Tax Act, or is generally deemed to lack commercial substance, or the purpose of the transaction itself is not bona fide. Right. One important point to note is that when GAAR is applied, there is a presumption against the taxpayer, unless proved otherwise, that the transaction is an impermissible avoidance agreement or an impermissible arrangement, and therefore the onus is on the taxpayer to prove otherwise. So coming to this, we'll sum up today's discussion and see the key takeaways that we could take home from today's discussion on creating or setting up presence in India for foreign companies. We've summarized these key takeaways in this slide. And basically, while creating or while sort of identifying whether a direct entry or setting up a separate legal entity would be relevant, the form of business and determining the form of business presence to be created in India, it is relevant to see on a case-to-case basis the actual business objectives of the foreign enterprise, like we discussed. It is relevant to see the right blend of repatriation mechanics to strike a balance between tax efficacy, both in India and abroad, and also seeing the exposure to anti-avoidance rules, right? So even if a holding structure through a tax efficient or or a beneficial tax treaty jurisdiction is created, it should meet the commercial substance requirements and should not be abusive as such. Then the structuring, while structuring of investments, the exit tax strategy is equally important, like we discussed. And any continued business interaction in India, either directly or through contractors or consultants, should be vetted for PE exposures. We've discussed this in detail. Like we discussed, secondment structures are very helpful where employees are required to be sent for prolonged durations. And these structures should be carefully implemented and tested for integration of the employees being sent to India with the Indian entity. Like we discussed, given that Indian tax authorities are fairly aggressive on source-based taxation, any receipts emanating from India, especially on passive income streams, such as interest, dividend, FTS, etc., should be vetted for withholding tax exposures. I open the floor for questions if we have any time from the participants. That's all from my side. Thank you. Do we have time for questions?
So yes, you can take up the questions.
Sure. Can you please ask or pick any of the questions? I am unable to see them in the chat window. Or we can separately answer your questions, or you can write directly to me in an email, and I'll be happy to answer your questions regarding the discussion that we've had today.
Yes, we can do that as well. They can write directly to you or sales@taxmann.com.
Sure, happy to do that.